Well, stocks not too far from the flat line here this morning to close out what has been a very volatile week here for the markets. Much of that volatility fueled by whipsaw tariff policy and also the latest econ data. The VIX, it's a key measure of market fear that jumped to the highest level of the year as investors scramble to navigate market volatility. Joining me now, I want to bring in David Booth. He's a co-founder and chairman of Dimensional Fund Advisors. His firm's strategy is rooted in academic, evidence-based investing rather than trying to time the market or pick individual names. Booth also helping to shape the landscape of institutional investing, a focus on quantitative investing and factor investing. David, it's great to have you here at Yahoo Finance. We also want to welcome in our executive editor, Brian Sozzi, as well. David, there's so much to get into here with you. I'm curious just to get your sense of where we stand today. Following the sell-off that we have seen in the markets, obviously some of the jitters that are clearly very evident right now from investors, and then pairing that with some of these slowing econ data that we have been getting. How should we be thinking about where we stand?
Well, I think if you're talking about investing in stocks at all, you got to continue to focus on the long term. Trying to time short-term movements is pretty difficult. This week, the news that's out and the amount of adjustment all seems kind of sensible to me. I mean, unless you could forecast these events happening, it's hard to make money off of that. So we counsel our clients and our advisors to focus on the long haul, and educate people more and more about how markets work. The more people understand about how markets work, the less anxious they get in times like this, and the better able to stay for the long haul. And if you can stay for the long haul, you get that benefit of that magic of compounding. The way that Einstein talks about as being the eighth wonder of the world, So every time I've been in the business over 50 years, and if you look at the things that make me unhappy, it's every time the market drops a lot, a certain number of our clients panic and go, the sky is falling, I got to get out of here. And that makes me sad because it's very difficult to get back in once you make that decision. You get out and you go, then the market takes off and people go, well, the train's left the station, I can't get back in now. I thought it was overpriced before and now it's even higher. So you just have to be very careful about all of that.
David, the headlines are coming in hot and heavy. Are your clients panicking right now?
No, we have, the history of our business is we have new clients come in, probably like everybody else's new clients, and they're trying it out. And then you go through a couple of downturns and upturns, and over time, and we've been to the business 43 years now, what we have are clients that are really are long-term investors. And frequently when we call up and say, look, let's chat about it. You don't need to talk to me. I know what you're going to say, and I'm in this for the long haul. Now, I do think there's the other side of the coin is, in setting investment policy, you try to set it for your particular situation, your conditions. Well, maybe the market, people focus on what's happening in the market. Maybe you should focus more on what's happening in your personal life. I mean, there may be more variability on what's happening in the personal life if you look at the potential for a lot of layoffs and so forth. Maybe spend a little more time thinking about that. But in general, when you go home at night, instead of trying to time short-term moves, spend a little time with their kids and be a little bit more relaxed, I guess.
Are long-term investors becoming less optimistic on the long term because of the policies we're seeing from the administration? One
of the interesting things about studying the behavior of the stock market over long periods of time is you can't find much connection between which party's in power, which Congress is leading the way. Markets, it's always helpful to remind people how markets work. These are buyers and sellers coming together, and they don't trade unless each side thinks they got a good deal. Yeah. And that's what happens with that kind of environment is prices, the way I view it, is every day prices are getting set at levels that induce people to come in to invest. If prices were too high, they wouldn't invest. And that's kind of I think that's what comes out of the research into security prices.
And David, I know that in college, I believe you worked on a stock service that aimed at you trying to come up with ways to beat the market when you were in your early 20s, and I imagine that was very difficult. We have a lot of retail investors listening. Do you think it's possible for retail investors to beat the market, just given how much access to data, to information institutional investors have?
Well, it's possible. It's not likely, but it's possible. I think too many people feel like they are outsiders, and it's really just the insiders, these institutions, that are getting all the business. The good news about all the research is that's not true. If you look at, it's very difficult for individual investors to beat the market. It's very difficult for professional investors to beat the market.
Yeah.
And if you look at the likelihood of beating the market, it's about the same for each, which is very encouraging in the sense that it's the democratization of investing. Everybody has about an equal chance of picking a winner, I guess. And that's the way you would hope markets would work.
David, I guess your assessment of risk today versus what we saw 10 years ago, 20, 30, 40, 50 years ago, there's a lot of consistency there. I'm curious to get your perspective just how social media at all influenced some of the moves that we're seeing today, and I guess how that then affects maybe the calculus or psyche of so many investors today, when it didn't necessarily, obviously, before we had social media 20, 30 years ago.
That could be. I mean, there's definitely a lot more information.
Yeah.
Well, actually, there's a lot more data. I don't know how much information's out there. I mean, there's a lot more noise. I don't know if there's any more signals in those noises and that noise, but that's you look at the VIX today. You were talking about that. It's it's shot up recently. As you look back on things, you look at the first Trump administration, one of the characteristics was extremely low volatility. And even a lot of that carried through with the Biden years as well. So over the last, say, couple of decades, we've really had historic low volatility. Now, will we go back to, don't know. But, it's a worry when everything's so combative. And I think the amount of uncertainty probably is a little greater now. I mean, just read the newspaper. I'm not forecasting anything, but this, in some ways, it kind of reminds me of 2020, March of 2020. The market's down 20%. COVID has just really hit. People are going, God, what is this COVID all about? How can we look at all the uncertainty? And what we said back then, and probably say now, basically every day, is, hey, look. People, when bad things happen to them, they just don't sit there and take it. They figure out what it takes to get it back on track. And same way with firms. And so with this COVID hit, firms are going to do what it takes to get back on track and use their ingenuity. And there'll be winners and losers along the way. And I don't know who the winners and losers will be. But what makes all of this go around, what makes this all work for all of us, is human ingenuity. People, I don't know, if bad things happen going forward, people will react to it. People sometimes say I'm an optimist. I'm a realist. That's human. That's the way humans work. We want to improve our lives, and I think that's the thing to keep in mind always.
So then I wonder how you're thinking about the tech trade. I know you don't believe in bubbles, but do you think that we are heading toward a tech, whatever word you would use for valuations?
I wouldn't. That's not my guess. My based on the study of the markets, I think maybe your best idea of what the expectation is basically about whatever the market does, maybe a little less, just because people view them as being lower risk now. And if you believe in risk and return related, if you think they are less risky now than the market, then you might expect a little lower return. It's a little simple, sounds simplistic, but look, let's call the Fab 7 or however many. I'm a basketball player, Fab 5. There's now, let's say that's a third of the market. Well, think of that as being, start with your portfolio, maybe that should be a third of your portfolio, and then argue you up and down from a third, not 0 or 100%, I think is a better way, and that'll keep you out of the kind of extreme outcomes, I think.
You're out with a new documentary. We've talked a lot here about noise impacting stock prices. I mean, your documentary is called "Tune Out the Noise." Have you really been able to do that over the decades of your career? Just isolate yourself and just almost like Warren Buffett, just invest for the long term and just focus on sales, margins, and cash flow, and kind of forget everything else that's happening around you.
Yeah, that's right. I mean, here again, going back to how markets work, I sit back and let everybody else do all the work, setting prices. And I figure however it comes out for the market, that's probably a better estimate of what prices should be than if I tried to figure them out. So I'd rather focus in on how my portfolio maps into my personal life. I'm getting closer to the retirement age. I keep telling myself that.
So you have a lot of dividend payers. Does that still hold true? Own dividend payers when you're nearing retirement? Is that like a good tip for those nearing?
Most people, it depends on your situation and what your objectives are. Most people, when they start planning for the end, frequently say, I'd like to leave some money for the kids and some money for some charity. And other than that, I want to spend all the rest. And so in that kind of environment, probably taking some risk off the table is a pretty good idea.
Well, David,
yeah.
Sorry, go ahead.
No, in my case though, I look at it and go, some charity is the residual claimant on what I have. And so if I take the risk and that just means, and I lose, then the charity will end up with less money. At that point, I won't care.
Very valuable advice. David, it's great to have you here on set. Thanks so much for taking the time to join us.
Thanks for having me. I enjoyed it.
David's new documentary, Tune Out the Noise, explores how firms like Dimensional disrupted Wall Street's traditional model of investing. You can get it now on YouTube. And of course, our big thanks to Brian Sozzi as well.